Okay, let's dive right into this. Welcome to The Explainer. Did you know that over half, literally more than 50% of all SaaS acquisitions just fall apart right at the finish line? Today, we're tackling what is arguably the single most important financial event of an entrepreneur's life, selling your founder-led SaaS company. I mean, you've spent years grinding, building your product, securing your customer base, and growing an amazing team. The stakes? They literally could not be higher. Nail this, and it's a massive, life-changing win. But what happens if you go into this process totally blind?
Well, here's the harsh reality. If you jump into the sale process completely unprepared, you aren't just risking, a slightly lower valuation. You are risking a totally catastrophic outcome. We are talking about lost revenue, a fundamentally broken team, and basically tearing apart the very company you spent all those countless late nights working to establish.
So the founders who actually close strong deals, they do the work first. And here is your 5-pillar roadmap. 1. Exit objectives. 2. Pitch story. 3. The AI reality check. 4. SaaS metrics. And 5. Deal structures. This right here is your ultimate framework to help you gain absolute clarity, confidently navigate buyers, and protect your legacy.
All right, Pillar 1, define your exit objectives. Listen, selling a SaaS business is never, and I mean never, a one-size-fits-all situation.
You really got to sit down and ask yourself, what do you actually want? Are you just looking to receive the absolute highest possible selling price? Are you trying to reduce your personal risk? Maybe you want to identify a buyer who can really fuel your future growth. Or is it all about maintaining your team and that customer culture you built? Because, spoiler alert, these competing priorities don't always play nicely together. Founders who just blindly chase the maximum bid often end up locked into these miserable 3-year earnouts with totally suboptimal long-term structures. You need a prioritized list of objectives from day one. That way, when offers actually start rolling in, you're evaluating them against your own predefined framework, rather than just getting blinded by the numbers.
Moving on to Pillar 2, craft your pitch story. Now, when you finally get in front of a potential acquirer, whether that's face-to-face or over a Zoom call, remember, they are assessing way more than just your revenue.
Put yourself in the hot seat for just a second. Imagine the buyer looks across the table and flat out asks you, why do your customers actually stay? And exactly where is the best growth opportunity for this product? Let that sink in. If you don't have a razor-sharp response queued up immediately, trust me, the buyer is going to notice. And suddenly the AC in that boardroom is going to feel a whole lot warmer.
There is just a massive contrast between real preparation and making it up on the fly. Vague answers, they instantly trigger alarm bells about your product market fit, your dependency on maybe just a handful of key customers, and the depth of your leadership team. But if you fire back with highly specific answers, you create true, genuine excitement in the eyes of those buyers. You prove you actually know your business inside and out. Remember, your growth story isn't just marketing fluff. It's a solid, concrete business story.
And this brilliantly illustrates our next point, Pillar 3, the AI reality check. Because let's be honest, the business story you tell today looks wildly different than it did even a couple of years ago.
The market shift here has been honestly kind of violent. Just 18 months ago, having AI was viewed as a nice add-on feature, right? Kind of a neat little bonus to mention. But today, it is completely taken for granted by serious purchasers. Buyers now fully expect you to leverage AI to optimize your operations, push products to market way faster, and deliver significantly greater value to your customers.
But it goes way beyond just slapping some AI into your workflow. You have to understand the existential threats. Serious buyers are absolutely going to ask you, can AI-based rivals just strip your competitive moat away overnight? What's the actual cost to recreate your basic product functionality from scratch right now? And what do the next 3 to 5 years even look like for your specific software? The AI pioneers who actually stand out are the ones who can articulate both the massive opportunity and the very real risk with absolute clarity. AI literally has to be integrated into the core business itself, not just thrown into a sales pitch.
Which brings us to Pillar 4, master your SaaS metrics. Now, I need to warn you right out of the gate, potential buyers are incredibly diligent. They're going to dig into every single assumption in your financial projections.
You have got to know these essential metrics absolutely cold. We're talking EBITDA for your true operational profitability, your net revenue, your new logo pipeline, net revenue retention to prove people actually stick around, also GAAP accounting and cash accruals. And look, these aren't just fancy buzzwords to memorize. They provide crucial, undeniable insights into the health and scalability of your business. If you don't confidently believe in your own numbers, you are not getting the deal. Or, at the very least, you're going to grind the whole process to a painful halt.
And here's the kicker. Just knowing the numbers isn't enough. You have to actually perform to them while the sale is happening. Buyers are watching your execution like hawks. And honestly, here is the hard truth. Even a slight miss upsets the price. It adds immediate uncertainty, and it leads straight back to renegotiation. I have literally seen deals lose millions in valuation at the 11th hour, all because a founder missed their Q3 target by just 2%. You absolutely must hit your goals before closing to build that trust and solidify your valuation.
All right, final stretch. Pillar 5, navigating deal structures. Assuming your metrics hold up, you finally arrived at the final boss of the selling process. This is where we shift our focus completely away from just that big, flashy headline purchase price.
There is a super crucial mantra you've got to remember here, and it's this. The deal structure is the story. Your life for the next few years is your buyer's operating model. I love that quote because it perfectly underscores how vastly different types of buyers will completely dictate your future day-to-day reality as a founder.
Let's contrast two very different buyer profiles to really see how this plays out. On one hand, you have permanent capital buyers. They intend to keep your business forever. So naturally, they focus heavily on leadership continuity, post-close investments, and preserving your culture. On the flip side, you have growth-oriented PE firms, private equity. They typically have a strict set time horizon, meaning their cost and scaling logic is totally different. Now, neither is necessarily better, right? But one might be way more suitable for you depending on those initial objectives we nailed down way back in Pillar 1. Understanding these deal structures and the sneaky conditions of any earnouts is honestly just as critical as that final valuation number.
Preparing for a sale isn't just about driving up the price tag. It streamlines the entire process, it drastically lowers your stress, and most importantly, it safeguards what you spent years building. So, I'll leave you with this final provocative question. Are you fully prepared to safeguard the legacy you built, or are you just chasing a headline price? Take the time, do the prep, and get absolute clarity before that first meeting. Thanks for hanging out with me on this explainer, and I really hope this helps you execute your exit the right way.